Hey, what's happening, guys? I hope you're doing well. Today, we're going to take a deep dive into one of the most popular down payment assistance programs that we have had a lot of buzz about. It just launched today. Today is Monday, the 27th of March, and this is from CALHFA. This is called the Dreams for All Shared Appreciation Program. So we've already gotten calls on this. We've had calls for probably the last month asking about more information. When's it going to launch? How's this thing going to work? It's got a lot of buzz. So I think CALHFA did a really good job trying to kind of get people excited about this one. But let's take a quick look. What is the program? What's it all about? So first and foremost, this is a conventional loan program. So it's based on conventional financing for the main loan, and the down payment assistance component of it is going to basically cover 20% of the down payment. Now, you can use that 20% in a variety of different ways. So you can use it for your down payment. You can use it for your down payment and your closing cost. You can use it to pay points and buy your interest rate down. You can use it to buy out mortgage insurance. There's a handful of different ways that you can use it. I've got some examples later in the slide deck here that I'll walk through with you. But just first and foremost, know that it's going to be 20% of the home's sales price or the appraised value, whichever one's less. So if the appraisal comes in a little lower, we're going to have to adjust that number. But assuming that it's going to match the sales price that you go under contract in, that 20% is yours to work with your lender on exactly the right structure to make sure you use it to your benefit. Again, it's mentioned earlier that it's a conventional based loan program. This is really good because a lot of times FHA loans sometimes have some restrictions on maybe condos, for example. They have to be FHA approved. Conventional has a little bit of a wider network on condos. So expect to be able to use a program like this on condominiums. This loan has zero monthly payment that's due, and there's zero interest. Okay, so how do they make money on this? They're going to make it back on shared appreciation. I'm going to show you that in an example kind of toward the end of the slide deck. But essentially, the 20% that you get up front, you're going to pay that back, and CALHFA is going to participate in the appreciation as that property gains value over time. So who's this thing for? You got to be a first-time buyer. Now, sometimes people are confused. First-time buyers, they go, well, I owned a home several years ago. That's okay. If you've owned a home several years ago, but maybe haven't owned one in the last 3 years, you're considered a first-time buyer by definition. So anyone that has not had home ownership interest in the last 3 years, you're a first-time home buyer, and you can use a program like this. You got to occupy it. This is for primary residence only. This is not going to be your second home. It's not going to be for investment properties. This is one that you're going to use to move in and live in. All right. You have to meet the income requirements. There is a ceiling on how much income you can earn. That is according to CALHFA. I'll show you that in the next slide. There's a income limit. If you earn more than that income limit, sorry guys, you're going to be out on this one. If you earn less than that, this is a program you should definitely check out. And then there are special terms for low to moderate income. So basically anybody that's 80% of the area's median income, you're going to have a different repayment schedule. And then lastly, what can you use it on? You can use it on a single family residence. You can use it on a single family residence that has a guest house or an ADU in the back, as long as it's still zoned as a 1 unit. You cannot use this on a 2 unit, a 3 unit, or a 4 unit. Sorry, those are going to be out. Those are more investment oriented. This does work on a single family 1 unit, and you're going to be able to use it on condos as long as they're Fannie Mae approved. And on top of that, these do work on manufactured homes as long as they're on permanent foundation. These are not going to work on your mobile homes that are in a park. These do not work on single wides that are out in the middle of nowhere. These have to be a manufactured home on permanent foundation. All right, so let's talk about the income limits. I think this one is an area that I'm really excited about. See, years ago, we had programs like this with income limits that were really, really restrictive. It used to be things like, 50 grand. And the minute you made over 50 grand, you're done. You can't get any kind of down payment assistance. But check out these income limits. Look at LA County, Los Angeles County here, $180,000. So if your earnings are $180,000 or less, this program is totally fine for you. Orange County, $235,000. But here's the one that really surprised me the most. Scroll all the way down here to San Mateo. San Mateo, you can earn $300,000 and still get down payment assistance. That is literally insane. I haven't seen anything like that in a very, very long time. That is very generous. Guys, San Mateo is not a cheap place to live, but guess what? You're probably making pretty good money over there. But 300 grand, if you're making less than that, can use this program in San Mateo. What does that 80% area median income look like? So this slide right here, I'm just taking a quick snapshot of kind of our backyard here in Palmdale, California. You can see right in here, 80% area median income is $78,320 as of right now. So that means that the repayment schedule will be slightly cheaper for somebody that makes $78,320 or less. So if you make more than that, then you're going to have the normal program. Doesn't mean you phase out of this program. You have a little bit of a special deal. You're going to have to pay back 15% in shared appreciation versus 20. So you save 5% on the shared appreciation if your income is at 80% or less of the area median. So this example is going to be on a $450,000 purchase. So let me kind of walk you through this. 450 blended rate, and I'm going to talk about this in another slide here. Blended rate would be right around, at least today, about 5.147. I'm going to show you how I come up with that blended rate in just a second, because the interest rate is definitely higher than that, but there's a blended rate over the overall cost of money that you're borrowing. Make sure that you understand that. What does that monthly payment look like? $29.63 would be the forecasted payment. Here's the breakdown. Principal and interest, $23.5448. Estimated property taxes, $468.75. Estimated homeowners insurance, about $140. No monthly mortgage insurance. So on this example, I wanted to build it where somebody bought it at $450 and they're using the 20% to go toward down payment, closing cost. And because we're using some of that 20% toward closing costs, normally it would put us in a position where we need a monthly mortgage insurance. But in this scenario, I'm actually buying out the mortgage insurance. I'm going to pay a one-time fee to get rid of it. So this scenario is no monthly mortgage insurance, and you've got the down payment and the closing costs covered in this. And that at $450, a total payment of $29.63, guys. That is really, really solid in today's market. Here is kind of how the whole thing stacks up. Your first mortgage here would be about $377,400 in this example, and that interest rate today was 6.375. Remember, it said blended rate 5.147. Why? It's because you've borrowed 20% of that $450 is $90,000 at zero interest with no monthly payment. So the total, if you blend these two and you add these together, says your blended cost of the money you're borrowing is actually only 5.147. I want to point that out because sometimes on these down payment assistance programs, we get a little bit wrapped up in what the interest rates are, and they can oftentimes be on the high side. But this is actually really, really good. When you have $90,000 at 0% and you blend it with, your main loan at 377 at 6.375, you have a blended average of 5.147. Sometimes because these interest rates start off a little higher, we're kind of worried about, if we were to refinance in the future, what happens to have to pay this money back? The answer is yes. And that might hold somebody back. But looking at the blended average, this is significantly lower in today's money than what the going interest rate would be on a 30-year fixed loan. So this is something that I really wanted to make sure you guys understood and point out. There's a big benefit there. Let's take a look at how it compares to other down payment assistance. I'm going to use this is in the same household. So CALHFA is the entity that's created this Dream for All program. And CALHFA also has one called a Cal Plus. It's also a conventional down payment assistance program. And you can see right here what happens with not only the blended rate, 5.147, this one right here, 7.678. So the main loan on this one was 8.125. They have a 1% assistance for the down payment, and then a zero assistance or 0% assistance for the closing cost portion of that. So the blended average is 7.678. Your monthly payment down here, $29.63, like we discussed earlier. Well, guess what? It would be $38.49 on this other one. It's huge, big difference here. Saving a whole lot of money by using a program like this. Cash to close. Technically on the Dream for All, you cannot get money back. So this would end up being a wash. We would do a principal reduction to zero this out, but it does show negative $28. You can see it's covering the down payments, covering any of the closing costs involved in the program. It's got the appraisal, the recording, the escrow, title, all that is all built into one place, and no additional funds needed from the borrower. Then over here, this one pretty much does the same thing. You still needed just a little bit, about $623 or so out of pocket. The assistance covered the majority of the closing cost and the down payment without having to ask the seller for any concessions. So can be maybe a little bit more aggressive on your offer price using a program like either one of these, but obviously comparing the two, Dream for All looks a little bit more solid. All right, how much do I have to pay later? Because this is a shared appreciation program. This is one that we really want to take a deep dive into and understand, okay, what's the catch? I got a lower monthly payment, I got in the door, I'm going to probably have to pay this thing back a little bit later. How much is it going to actually cost me? So let's just build an example. Let's say that the home now is worth $600,000 when you go to sell it or you go to refinance it. Remember, refinance will trigger the due on sale and the appreciation share. So when you sell or refinance, in this example, you bought it for $450,000. So your gain was $150,000 worth of equity. And the shared equity, assuming that you didn't meet the 80% or less area median income and get the discount, it's going to be 20% of the equity. Okay. So in this case, 150,000 times 20% is $30,000. Initially, when you got the loan from day one, you took 90,000. That was your 20% of 450. So we're going to add the 30 and the 90 together. It's going to give us 120. So if you sold at $600,000, you would have paid down. Hopefully this takes a little while to kind of get there. You've been paying for a little while. So your main loan has dropped down a little bit, but you still are going to owe, even though the appreciation was about 150,000, you're going to owe 120 in this case to the program. All right. So it's going to take a fairly large chunk, but remember, this 150 was appreciation. It was your equity gained, and that 90 went against your down payments. Your payoff on the first is significantly lower. So it's not like you're going to be left with zero. You're going to actually really out of this 150, you're only paying 30 of that in shared appreciation. So really a pretty fair trade. The program does have a cap. And this is one thing I discovered when I was looking at the guidelines. This part's really cool. The cap is only 2.5% of the entire amount that you ever borrowed. So in this example, $90,000 was borrowed, 2.5% is $225,000. That's the most that you can have in shared appreciation. So let's say that you bought that home at $450,000, somehow or another, some miracle, the house now is worth $3 or $4 million, and you don't want to pay this thing back. And you're going, oh my gosh, I just made a huge mistake. I'm giving up 20% of that. You're actually going to only pay back $225,000, whatever the 20% of the future to that $225,000. $90,000 was the initial, and in a worst case scenario, now this house is worth $4 million, and you would have to pay back $315,000. So you got 90 from day one. The cap on the shared appreciation would be $225,000 for a total of $315,000. Guys, super, super cool program. Let me know if you have any questions. You need to see some specific examples for you or your clients. Please reach out. Got my information right here. We look forward to serving you really, really soon. Thanks so much.